So this is part sort of our forecast for the price of gold, and it's also part technical analysis to show you some of our technical analysis techniques, because you can take these away and you can use them yourself. We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Welcome, everybody, to another episode of Talking Trades. Of course, there's Kevin Wadsworth and myself, Patrick Karim, and today Kevin will ramble on about gold. That's right, guys. He will ramble on about gold. So enjoy it.
Yeah, okay. That's what I said to Pat a second. What we're going to talk about, I said I'll ramble on about gold. Those were my exact words. So what I'm going to do is talk to you about how we analyze the gold price chart and what it's telling us for the next few years. Where we think the price of gold is going to go. And so this is part sort of our forecast for the price of gold. And it's also part technical analysis to show you some of our technical analysis techniques, because you can take these away and you can use them yourself. So I'm going to share my screen now. And what we're looking at is the gold chart. It's the line chart for gold. First thing to do when you're looking at any chart is to look in the top left-hand corner, see what the instrument is, spot price of gold in US dollars, 1M. That means it's the monthly chart. So this line, every time there's a monthly price close, the line is drawn to that close. And then you get the next monthly price closing, and then the line is drawn to that. So you end up with a zigzaggy line that joins together all of the monthly closes. You can also view it on the weekly time frame, and that gives you a lot more data points. So you see the line has a lot more detail on it, because you're joining together the price at the end of each week. So if at the end of this week the price is $3,400, the line will move on in time by 1 week, and it'll move up to $3,400. So you can look at the chart across a whole variety of time frames. Now, the idea is when you're looking at a chart that goes back 100 years, like this one does, it's a good idea to put it on a bigger time frame, something like a monthly or even a quarterly time frame, because really you're just wanting to look at the broad picture. So I'll pop it on the quarterly time frame, and there you go. So that's the quarterly line chart. Pop it onto the candles, and each one of those candles represents 3 months. So there's a variety of ways of looking at the price chart, either as a line or as candles, and there are other techniques as well. So let's start doing a bit of technical analysis on this. And let's just first thing we tend to do is put on the major support and resistance lines. And up until recently, that black line there was a resistance line that hadn't yet been confirmed. But now it has, because if we have a little look on the monthly time frame and we put it on the line chart again, you can see that as the price touched that line for the third time in 100 years, it reacted. So it told us that that line was important. It's a line that has been defining the bull market peaks for gold, the peak back in the 1970s, the peak in 2011-12. And more recently, we reached that little peak there back in late last year. And now we've burst out above that line. That tells us something significant, something fairly major is happening here. Other things to notice on this chart, we've got a very nice textbook cup and handle pattern here. There's the cup, and here's the handle. So that's a cup and handle pattern. You could also draw that in a slightly different way. You can have a resistance line across here like that, and you can draw the handle like that, cup and handle. So either way, the price broke out at this $2,000 level. And when you get a breakout, that's when you take a position. I suppose some people try to catch falling knives. They might try and find a variety of techniques of estimating when the price has hit a low point, but that's a high risk strategy, because a low point can become even lower and even lower and even lower. As you can see, between 1980 and 2000, a 20-year period where every time you got a little move to the upside, the price went lower and lower and lower and lower. So you would have just sat in an asset that was going nowhere for 20 years. So buying the breakout gives you a higher degree of confidence that price is going to move in the direction that you want it to. We've got a breakout here back in 2002. And again, there was a nice cup pattern here that formed at the base, which is quite often the case. Not always, but quite often the case when you form a meaningful low point. So a number of different technical chart patterns jump off the screen at us. And the question now, of course, is where do we think gold is going to go over the next few years? Well, we can start just backing up the evidence here a little bit by putting an indicator on the chart. And one of them is the distance from moving average, just to see when the price of gold starts to get a little bit stretched historically. And if I just put a line on the chart here, there we go. So you can see that if we just, for the time being, ignore the 1970s, then during the last major bull market, the distance from 3-year moving average, that's what this indicator is at the bottom, it didn't get any higher than approximately actually where we are now, this sort of level where we are now. We peaked at that level back in 2006. And when we peaked at that level, gold fell sort of 15% or so, I think it was, maybe more, maybe 20%. I can just measure that for you and get a more accurate number. It fell, a little over 20, even 25% when we hit this peak here. And in 2008, it fell more like 30% when we hit that distance from moving average. When we reached that distance from moving average back in 2011, that was the end of the bull market, and the price of gold fell over 40% and took 3 years to fully recover and start making new highs. So clearly the distance from its 3-year moving average is important, and we hit that sort of level just recently. And of course, we've had 4 or 5 months now where the price of gold has not made new highs. And if I zoom right in to where we are now, this is April, May, June, July, and August. And you'll notice that each of these candles goes up to around about $3,450, even $3,500, but then it closes the month back down either in the middle of the range or lower. So we've had 5 months now of the price not making new highs. And we know why that is. It's because effectively gold has run out of energy. It needs to reset. Now, this little pullback here that we've seen may be enough for us just to resume again and get somewhere close to that black line, or even just a touch higher. And that could propel gold to somewhere around, I don't know, $3,800, $4,000, somewhere in that sort of order. That is plausible, but we really will starting to be getting to stretch territory at that point. Now back to the 1970s, and why did I say just, ignore that for the time being? Well, of course, in the early 1970s, the price of gold was pegged. And so the 3-year moving average was static and stationary and not able to move. So when gold was able to freely float and find its true market value, if you like, it rocketed upwards, leaving the moving average way behind, and the moving average was having to play catch up. So that goes some way to explaining why the distance from moving average got so stretched. I'm not saying it can't get that stretched again if we have some kind of, event, some kind of monetary reset or something that, that echoes or has a similar sort of effect as the 1970s there, that allows the price just to move vertically to the upside, then maybe that is plausible. But also note that the move that we had from this breakout here to $2,000 has been more than replicated by the recent breakout move. So again, from the point of view of looking at measured moves, which we do in technical analysis, that is getting very close to the sort of target area. But nevertheless, when we look at the broader picture for gold and we look at the supporting weight of evidence, we find targets in the $8,000 to $12,000 range, and perhaps that's a discussion for a later talking trades. But as long as we are above the 12-period moving average, the 36-period moving average, the Ichimoku cloud, and we're breaking out through our breakout lines like this, the long-term picture for gold is all very bullish. So whatever pullbacks we happen to have, and even if we pulled all the way back to the support line at $2,800, that would be an opportunity set within a large long-term bull market, according to the weight of evidence. So hopefully that's given you a little bit of a starter for getting an idea how to do some long-term technical chart analysis, Pat.
That was brilliant, Kevin. And I'm sure everybody enjoyed that rambling. It was very enlightening. Long-term uptrend for gold. no problems there, and use the TA to spot those lower risk entry points. All right, guys, thanks for watching this episode of Talking Trades. Make sure to like, subscribe to get more content like this. Take care, guys.